Thanks for joining us today, and I hope you find some interest and value in our deep dive today when we're going to be looking at the changes to inheritance tax and how the non-dom rules changes in the Halloween budget of October 24 in the UK affected expats living and working abroad. So, without more ado, let's get going. Thanks a lot for joining us today. In the Halloween budget, they changed the non-dom rules quite dramatically to affect not just expats living and working in the UK, but expats living and working abroad. So what we're going to do today is briefly summarise what the changes are for expats in the UK, but actually look about what the options and what the benefits are to expats that are leaving the UK and going to another country, because there's some longer term plans that could be made there for expats that are living around the world. Some of those have been anticipated and cut off in the changes of the rules. The Labour government are actually only implementing a change to the non-domicile rules that was already proposed by the previous government in April 24. So we can't expect that this to be undone in the future. So this is a seismic long-term tax planning change unless some radically different type of government gets into the UK in the next 5 years. So although we're talking about changes to non-dom rules from the 5th of April 25, some of the changes became effective from the 30th of October, from the date of the budget and the night before Halloween. So let's start having a look at that. What we want to emphasize as well is that when you're planning and tax planning abroad and across border, whether it's for your family or for your business or for your investments, you can't hide, and we don't want to hide. At ProAct, we always follow the rules to make the maximum tax saving, but you have to pay, do the right thing to order to avoid problems later on. For many years, discrete tax planning means that somebody doesn't know, but with international exchange of information rules applying to all financial services organisations, whether it's a bank, a property tenant, a property conveyancer, a lawyer, an accountant, any sort of regulated business service provider, all that information flows into the system between tax officers, so it can ultimately be checked and regulated. So the best thing to do is to organise and plan ahead, take professional advice from people like ProAct Partnership to manage your family and your business living and working abroad, so that your overseas property and business and investments don't suffer the taxes and the inheritance taxes that you due. We said before that income tax was introduced about 300 years ago, and 60 years ago the Labour government in the UK introduced capital gains taxes. Inheritance taxes followed on from that. So they're taxing your income, they're taxing your savings and your investments, and now they're taxing your death with even more aplomb. Because don't forget, with inheritance tax now, it's not just your property and your savings, but it's also your pension fund as well. So the pension funds have been added in to the inheritance tax mix. So if you're an expat in the UK or abroad, inheritance tax, not only is it more liable to catch up with you, and not only are expats now going to be deemed domiciled in the UK sooner and be liable to inheritance tax sooner, but it's going to stay with them. There's going to be an inheritance tax tail when you leave the UK, and it's going to stay with you down the years, including your pension fund, which is going to help to use up your personal allowance as well. But the bright side is for expats that are relocating overseas, there is this potential for you to potentially get rid and shake off the inheritance tax tail at some point if you're a long-term British expat, considering what the consequences are. And never forget with inheritance tax, um, and it's about domicile. And your domicile in the UK, if you're born and your origin is the UK, uh, or if you're an expat, if your intention is ever to return to the UK, and that intention could be uh, written in your will to bury you in the family crypt back home, or it could even be to have your ashes returned to the UK, and that could be used to deem you domicile if need be. So let's follow the rules and let's take the steps necessary. It doesn't suit everybody, but if you pay tax on your income and you pay tax on your investments and you want to save inheritance tax when you die, so that your um, family across border and down generations can benefit, um, contact us at proactpartnership.com. So the big change is that after 4 years now, as a tax resident in the UK, you will be deemed domicile. So at the moment, under the current law till the 5th of April 25, you can be in the UK for 15 years before being, as a tax resident, before being deemed domicile in the UK. And under the current regime, you don't pay tax or declare um, liabilities for capital gains, inheritance tax or assets overseas while you're non-domicile. However, that's now been cut down to 4 years. So anybody that is in the UK for more than 4 years by the 5th of April 25 is going to be automatically deemed domicile from April the 6th. Have in mind that if you're trying to avoid and try to make some plans because you've already been in the UK for 4 years at the date of the Halloween budget, 30th of October, it's too late anyway, because for those people that would have been deemed domicile because they've been in the UK more than 4 years at the 30th of October 24, they will be deemed domicile anyway if there's something that's caught up. Already there's restrictions on potentially what we can do and what we are doing. So the domicile is based upon your origin and a set of subjective matters that would only be assessed and confirmed by the UK HMRC on death. The HMRC, if they give you an inheritance tax assessment, that will be when they can confirm that you're absolutely domiciled or non-domiciled. So a UK expat could leave the UK for 30 years and still the UK could deem them domiciled, but you won't know that until you do an inheritance tax return in the UK. So that's an interesting situation to be in. You have to die to get the assessment to be absolutely sure. Under the new rules, expat will benefit because that's no longer the case. You can absolutely work out whether you're going to be liable to UK uh, uh, inheritance tax on your worldwide assets. Have in mind as well, even if you're considered to be non-domiciled to the UK, even in your first 4 years, if you die in the UK or if you die abroad and you've got assets in the UK, then potentially you've got an inheritance tax liability that needs to be paid. So if you've got a business, investment, a property, or some other interest in the UK, um, even if you're living as an expat abroad, that could still be subject to inheritance tax in the UK. All these things can be reviewed, and Partnership offer a free review to all new clients, or you can pay for online consultant calls, advice and guidance to support you and your existing advising team. So the new residence, new domicile is based on residence. So if you're tax resident for a year, your domicile for that year. So it's more important now. Split year, uh, have in mind there, if you're going for a split year, you're still tax resident in that year just for part of the year, but that will mean that you'll be domiciled that year as well. So the year of leaving and the year of returning are part of the calculation of your tax resident for part of that year, so you're domiciled for that year. And after 4 years, you're deemed domicile for your global income, your global investments, and capital gains. So previously, a non-dom can be exempt from uh, capital gains, but that's not going to apply. So if you're deemed domicile in the UK, but you're selling an overseas property or business, that's now going to fall under the scope of capital gains tax, that you're deemed domicile in the UK. That's an important point. Uh, Capital gains is a disposal of an asset during your lifetime. And so if you've got a capital gain that's overseas, um, when a UK expat returns to the UK, um, a capital gain is chargeable any time in the year that they return. Um, if you're deemed domicile in the UK now, and that means after 4 years as a tax resident, then any disposal, any capital gain disposal during that year becomes potentially liable to inheritance tax. And so going forward, timing is everything. It's a quite important point that we need to understand that uh, the timing can make a difference to whether you've got a liability. So if you're selling overseas property, if you're selling overseas business and relocating to or from the UK, you can use a split year to protect overseas income during that transition period. But actually now you need to be wary that a capital gain any time during that year can be still liable to the UK. So it's going to favour getting your um, um, transition, your relocation date closer to the end of the tax year to give yourself maximum flexibility if there's potential capital gains during the remainder of the tax year. It could mean that you defer the disposal until the 6th of April, for example, to defer the tax liability in the current year. Um, if you're an expat in the UK, or if you're UK considering relocation, there's many places where you can go to consider making investments. Have in mind that with the changes that are coming in, um, uh, Isle of Man, Channel Islands were previously deemed to be separate locations and not necessarily assets that would fall under inheritance tax. Now, under the new rules that are coming in, uh, they will fall into the scope of inheritance tax. So somebody that's living and working abroad for very many years, but is holding an Isle of Man or Channel Islands investment fund or holding could now potentially have that investment fund fall under the scope of inheritance tax. And it doesn't mean that it's necessarily a bad thing, just going to affect the investment, but you might want to consider what that is going to mean for your long-term death planning, your estate planning with inheritance tax liability of 40%. No doubt the investment companies will change the arrangements, but if your offshore company is the Isle of Man with the zero tax, it might not now be the most tax efficient way of going forward. Uh, if you want to review your investments or your offshore company administration, contact us at porrickpartnership.com. It's also be aware that if you're using a trust arrangement, either as an expat in the UK or abroad, the settler, if they've got an interest in the benefits of the trust, then potentially it's going to be excluded from any exemptions under the non-dom status or domicile status. So it doesn't matter whether you're an expat going to the UK now for your first 4 years and still be treated as a non-dom, or you deem domicile in the UK, or your domicile of origin is the UK and you've gone abroad, If you've got a trust and you're the settler and you've got an interest in the benefits, then the dividends, the capital gains, and the interest earned from that are potentially subject to taxes in the UK, including inheritance tax. So not always going to protect you. So we need to think about those issues as well. For a non-dom expat joining the UK in the first 4 years now, um, they still got the option to have overseas workday relief. So if an expat's coming to the UK and he's got employment income from abroad, up until now, to 15 years of being deemed domicile, there's overseas work day relief, where employment overseas up to £300,000 a year, or 30% of the income, would be excluded from UK income taxes. So that 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 overseas workday relief is going to be changed quite radically, and be effective for expats living and working in the UK. So you need to consider how that's going to impact your tax return from the 6th of April 2025. Looking at inheritance tax now, um, we the new non-dom rules come into effect from the 5th of April 25. And under the old rules, you needed to be tax resident for 15 tax years in the last 20 before you could be deemed domicile, and that's gone now. Um, and, uh, but even if you leave the UK, you always have this inheritance tax tail, and as a UK expat, that was an element of uncertainty. But there absolutely is one now from the 30th of October, from the Halloween budget date, 24. The inheritance tax is attached to somebody that's deemed domicile in the UK. So before, an expat in the UK could be in the UK for up to 15 years and not be deemed domicile, leave the UK and not have an inheritance tax liability to the UK. Now, after 4 years in the UK, there's an inheritance tax liability because you're deemed domicile, and it stays with you even if you leave the UK. Uh, if you've been tax resident in the UK for 10 out of the last 20 years, then you potentially have an inheritance tax liability for the first 3 years after you leave the UK. Now, that doesn't necessarily stop you planning ahead. Under current rules, with inheritance tax, you can make a gift and it's potentially exempt after 7 years. So that those rules remain. You can make gifts to other people in the family, um, and they can be exempt as well. But now if there is an inheritance tax liability, it stays with you for 3 years after you've left the UK. Um, so it's an important point, and those changes come into effect from the 30th of October 24. So even if you've decided to quit the UK in the last 6 months, it's still not going to free you necessarily from that inheritance tax tail. So you need to consider what the options are and how you can move forward to protect yourself from the new non-domicile rules, which tax more of your income, more of your dividends, more of your investments, more of your capital gains, and now as well your inheritance tax and your pension fund. Private partnership are expat experts which can guide you whether you're living and working in the UK as an expat, or living and working abroad having left the UK. Contact us for more information and guidance. So where might you go? Not every country in the world has inheritance tax liability. The UK has got 10 countries where it's got an inheritance tax double taxation treaty with. But even so, if you've got a probate administration to do in the UK when you die, or a conveyance when you sell property, or make a gift into trust, then that's going to trigger a potential tax record or assessment for you. Um, uh, Other countries Some countries like Cyprus have no inheritance tax at all. It's not even a factor. Um, uh, and also Cyprus offers a trust structure where you can hold assets in the trust free of dividends, interest, income taxes, property rental taxes, capital gains taxes, and inheritance taxes. So for expats, it's an ideal vehicle to provide a platform, as some of the richest people in the world already know. Uh, it's not for everybody, but what it does is if you are not already a tax resident in Cyprus, you can enjoy an international family trust or business trust company in Cyprus and potentially avoid any liability to Cyprus tax. Now, it's not necessarily going to exclude you from taxes elsewhere, but it can go a long way towards protecting you from those excesses. If an expat does set up a Cyprus company, corporation tax rate is half that of the UK. So corporation tax rate, 25% in the UK, is 12.5% in Cyprus. So that's a straight benefit straight away for business expats. So it could be that a Cyprus holding company is more effective than um, some other jurisdictions. Now, Isle of Man, Dubai, don't have a corporation tax liability, so it's a lifestyle choice. With Cyprus, it's an EU destination, as would be potentially, in a way, Gibraltar, and Malta and Portugal. But with Cyprus, you've got this added advantage that there's no other additional taxes. For each country, it, it depends upon what your family and business want and where your business and customers and your lifestyle is based. But we can organize that in such a way that you can have a holding trust, a holding company uh, um, for your overseas property assets and investments, or you can relocate as an individual to Cyprus to enjoy zero dividend tax, interest tax, um, no tax on overseas property rental, and no inheritance taxes or capital gains. Um, it's a lifestyle choice. Um, we operate a Cyprus Trust for people with Dubai who want an EU administrative entity, um, but equally so, there are other places in the EU that you could operate. Just consider that the British sovereign territories like Channel Islands and Isle of Man are not necessarily free of inheritance tax anymore. Gibraltar is a funny choice at the moment. It's British sovereign territory, as is the Akrotiri part of Cyprus, but it's also part of the EU in terms of you've got an open border regulation and agreement between Spain and Gibraltar to freely cross that border. So what does this mean for family and business? It means that you need to consider restructuring your assets. That might be something as simple as gifting an investment, an existing investment into a new family trust based in Cyprus that would free you from a potential inheritance tax or capital gains tax liability down the line. Um, uh, 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 if you've got a pension fund, don't forget that pension fund is now liable to inheritance tax in the UK. If you vest the whole, if it's an invested pension scheme and not a final benefit scheme, if you take the whole of the fund out into cash and put it into an investment inside a Cyprus family trust, then yes, you will pay potentially income tax on settling the pension, but you can then get it into an inheritance tax environment. If you leave your pension where it is at the moment, in the UK, a pension is registered in the UK as a taxable entity. A pension is a form of trust. So you have to take the money out of the trust and get it settled into another jurisdiction. Even if you're receiving income from that pension in another jurisdiction, it's still home domiciled, that pension fund in the UK, and therefore it's still potentially liable to inheritance tax on death. So there's a consideration there where you could um, you could look to, sorry, I'm being distracted. Hi MC19. Thanks for your message, but I can't respond to that while I'm talking. Um, so there's a potential where if you vest your pension, uh, for example, Cyprus tax residents pay 5% tax, flat rate tax on pension income. In other jurisdictions, you can pay 10% or maybe even avoid that tax liability altogether. But then if you settle it into a Cyprus trust, you're free of inheritance tax and future dividend uh, and income charges. Consider the other scenario that you could do with your pension funds or your property rentals. So if you can consider making gifts, so that some of the options that you had as a UK-based trust have been lost because that protection, that connection, if you're a settler with an interest in the trust, although the trust is a separate tax entity, now it's been linked to the settler as well. So if the settler and the beneficiary are linked, that tie remains. So we can make a gift arrangement using a trust where the trust can hold the assets, but not necessarily provide a benefit to the settler and to free it from a potential tax liability. It may be that you don't need to use a trust, that you want to use a company. So a trust company can uh, uh, work better or as well as just holding a holding company to get invoice and transfer out income and assets from the UK. Now, there's restrictions on this. If you're a 20 million a year company, transfer pricing rules come into it as well, and we have to manage that. Uh, but we can still do it legitimately to pay the right amount of corporation tax at half the rate of the UK, and then avoid any liability to inheritance tax on the business assets, which can settle uh, depending on how the ownership goes, using a Cyprus International Trust or a gift to family. Um, if you don't want to use an investment trust or family trust or a business trust company, it may be that you just want to make a gift anyway. And again, these are possible. Now, it, it's a mixed emotion here. It depends what your family circumstance, what your needs are, and who you can trust, literally. But if you've got assets uh, that you don't want to enjoy, that you're just holding, then it may be that you could give those to family already. So there's personal allowances that you can make each year, and those gifts can be used to transfer assets to family or to charities or other destinations free of inheritance tax liability. A potential exempt regime works like that as well. So periodically, each 7 years, you can transfer a significant chunk of money away and protect it from inheritance tax going forward. If you leave your pension where it is at the moment, it's going to be liable in the UK. It's going to be liable to inheritance tax. If you have got the income as a Cyprus tax resident, you're paying 5% on tax on that. That's a very good situation to be. But if you vest the pension and get it invested separately, then you've got the potential to avoid any income tax and inheritance tax going forward. Um, these are complex issues, uh, potentially, or simple issues, potentially. We make a will because when we're going to die, we need our instructions and our wishes to be followed, um, which is great. But any probate administration needs tax clearance, and it needs inheritance tax clearance if there's UK assets. It needs inheritance tax clearance if there's an exchange of information with the UK, which gives a potential issue with um, uh, the, the settlement of the estate, even if that's overseas. Um, the although there's EU legislation that say that if you die in a country, you have to settle your worldwide assets in that country, there's still exchange of information with the assets that are abroad, which potentially triggers the UK to use its new rules to ignore settler interested trusts, for example, or um, uh, associated companies with the beneficial owners of those companies or those trusts being related too closely. So all this is monitored. We need to manage it and do that. If you take action now and you plan your property investments and business, living and working abroad and overseas, then you can potentially save your family across border and down the generations hundreds of thousands and millions of pounds, but only if you give yourself time. Project Partnership have been working in the UK and Cyprus for over 25 years for the EU, Middle East and UK. And if you want more help and guidance, you can contact us at projectpartnership.com. We have a free review to all new clients. And if you want to pay for advice, we can do that either in a verbal visitors meeting or a written report. For tax, residency, wills, probate and trust administration in the UK, EU and Cyprus. Thanks a lot for listening. Follow us next time on our Living and Working Abroad show. We're going to continue this deep dive and look a bit more into the process of managing the inheritance tax tail and what you can do to avoid and plan for that, to avoid the cost of delayed probate for your family and business living and working abroad. Thanks a lot for listening, and we'll see you next time.